Welcome to my morning report analysis videos on Thursday the 11th of October with me, Richard Perry, market analyst at Hantec Markets. We've had a massive sell-off in equity markets on Wall Street last night. There was a huge decline across the S&P 500 and the Dow, both down over 3%. The big move seems to have sort of originated from the tech stocks to an extent, but there was no real one major catalyst behind the event. I mean, we had comments again from Donald Trump yesterday where he attacked the Fed for tightening for tightening interest rates too fast. Said they'd gone crazy, and certainly that didn't help to sort of play into that equity market sell-off. But just general fears about rising yields in the States has led to this point whereby the VIX volatility, for example, shot to levels not seen since April. Now, this is the one big caveat on the chart here. Look at that move in January or late January into February on the VIX that saw volatility explode as liquidity levels were restricted, and subsequently we saw volatility spiking through the roof, and equity markets selling sharply lower. Now, that sort of the fears of those bond yields rising have certainly played into markets today. Now they're back a bit lower as you saw a bit of a safe haven move, but certainly with yields still above levels or sort of 7-year highs on the Treasury 10-year. It still is a concern, and that is playing into markets today. You can see that sort of selling pressure went through Asian markets, almost 4% there on the Nikkei. They're into the European markets as well, although maybe not as much as perhaps feared. Certainly the under pressure markets and the DAX 11,600, that is at lowest level since February 2017. Sort of now looks as though it's a big top pattern on the DAX. Yeah, we are really seeing this this move. Now, what we have also seen is the one main thing on the forex markets is the dollar has been sold off. You haven't really seen that contagion into forex whereby the risk appetite has plummeted, because it hasn't really done that. We've seen the Aussie holding up, we've seen the Kiwi holding up. Sterling remains fairly solid. Euro has rebounded above 15 big figure again. So it's an interesting move that ultimately has only really seen the dollar slipping back. Now, and that is certainly a yield differentials move. You can see that on the Bund yield spread under Treasuries, which has ticked higher as this euro dollar has also ticked higher. So there is a factor there. But certainly if yields sort of slip back now, then you could see that the dollar will be in a corrective mode. But I think the one main focus today will be inflation, and that inflation data for the US is out at 130 and could have an impact certainly on these treasury yields. If you see an upside surprise on inflation, either the core above 2.3, which is the expected, or the headline above 2.4, which is the forecast, then I think we could see yields pulling higher again, and that would pretty much see the dollar strengthening again and moves in forex coming under pressure. So it'll be interesting to see how this market plays out, this move today. But certainly equity markets are still under pressure this morning. Now, in terms of data points today, it is the US inflation data that we need to be aware of. You've got weekly jobless claims at 130 as well, 206,000 expected there, and the EIA inventories, builds of a build of 2.8 million barrels on the crude expected, distillates down by 2 million barrels, and gasoline down by 0.2 million barrels. So my chart of the day is the big one, the S&P 500. What we have seen is the S&P 500 has been in this long uptrend channel since March, where we hit the lows and started to climb again. That uptrend channel has been absolutely smashed by yesterday's move. Look at that size of the bear candle. As I said, it sort of brings you back to the moves that we saw in late Jan, early Feb, where the market really did sell off. Now, what we've got is the momentum indicators increasingly correctively configured now. But I've put on this chart the Fibonacci retracements of that February to September rally, and that we are bang on 38.2% fib now. So a break below that today, which the futures are calling sort of 0.7% lower again this morning. You could see 27.36, which is that 50% fib level. The next support, you're back below 2,800. That was a key breakout level that became supportive. You're below that now. You're sort of breaking all these sort of supports within the old uptrend channel. The next real support doesn't actually come in until 2,690 area. So there is real scope for further correction. Certainly the 50% fib level comes into play. And as I said, with the momentum so negative, and any sort of intraday rallies will be, I think, pounced upon as a chance to sell again, because there is a real concern in these markets at the moment. Now, in terms of recoveries, you really do need to see a move back above, on a closing level above 2,800 to really suggest perhaps a bit of an unwinding move. But even then, you're going to get the underside of this old uptrend channel as a basis of resistance around 2,850. And yeah, we are still, I think, under pressure. So it'll be interesting to see how this one plays out, how long this selling pressure comes through. Because I mean, people in the media have been talking about selling or a corrective move on the S&P 500 as being expected. Well, certainly it didn't look as though that was the case a week or so ago. But certainly now the correction is now accelerating and it is pulling lower. So expect further turbulence, I would say, in this market. So with that in mind, I wish you good luck in your trading, and I'll speak to you later.